Key Risk Management Techniques Introduction. Welcome to Key Risk Management Techniques, one of the most critical aspects of trading success. While identifying profitable trades is important, protecting your capital ensures you stay in the game long enough to grow. Today, we'll cover 4 essential techniques: position sizing, stop-loss orders, risk-reward ratios, diversification, and leverage control. These techniques will help you minimize losses, manage risk, and build consistency in your trading. Section 1. Position sizing. What is position sizing? Position sizing determines how much of your capital to risk per trade. The golden rule: never risk more than 1 to 2% of your total account on a single trade. Why is position sizing important? Prevents significant losses from a single bad trade. Example: with a $10,000 account, risking 2% means $200 per trade. Even if you lose 10 trades in a row, you've only lost 20% of your account. How to calculate position size? Formula: position size equals risk per trade, stop-loss distance. Example: account size $10,000, risk 2%, stop-loss 50 pips. Adjust lot size to ensure a $200 loss at 50 pips. Section 2. Stop-loss orders. What is a stop-loss? A stop-loss automatically closes a trade at a predetermined price to limit losses. It's your safety net when the market moves against you. How to place a stop-loss? For buy trades, place the stop-loss below support levels. For sell trades, place the stop-loss above resistance levels. Benefits of using stop-loss: prevents emotional decision-making when the market drops. Protects your account from large drawdowns. Example: buy your USD at 1,1200. Set a stop-loss at 1,1150, 50 pips below. Pro tip: use ATR average true range to calculate dynamic stop-losses based on market volatility. Section 3. Risk-reward ratio. What is a risk-reward ratio? It's the relationship between potential profit and potential loss. A typical target is 1-2 or higher, risking $1 to potentially gain $2. How to apply it? Calculate the distance to your stop-loss risk. Set your take-profit level at least twice that distance. Example: you risk $100 on a trade. Your target profit is $200, 1-2 ratio. Even if only 50% of your trades are winners, you'll be profitable over time. Why it matters: ensures that winning trades outweigh losing trades. You can afford to lose more often and still grow your account. Section 4. Diversification and leverage. Control. Diversification. Spread risk across different assets or markets. Don't allocate your entire account to a single trade or asset. Example: divide $10,000 among Bitcoin, Apple stock, and EUR/USD. Why diversification works: losses in one asset can be offset by gains in another. Reduces the impact of market volatility. Avoid over-leveraging. Leverage amplifies profits but also magnifies losses. Use leverage cautiously. Start with 1.5 or 1.10 until you build confidence. Example: at 100 leverage, a small 1% move against you could wipe out your account. Conclusion: key risk management techniques like position sizing, stop-loss orders, risk-reward ratios, and diversification form the foundation of sustainable trading. Even the best trading strategy will fail without proper risk management. Your next step: place a demo trade this week using 2% risk per trade, stop-loss, 1-2 risk-reward ratio. Track your results and refine your approach. Remember, protecting your capital is just as important as growing it.